My name is Michael Jabara. I head up ETF and closed-end fund research at Morgan Stanley Wealth Management. And for this particular panel, we're going to talk about chasing income, right? It's obviously a very hot topic. The Fed's going to act in December. They're not going to act. They're never going to act. Rates are going up. Rates are never going up. Quite frankly, I don't think anyone really knows the answers to these questions, but nonetheless, all of our clients, they need and want income. So I do think it is a pretty hot topic right now. With me on the panel is Eric Metz, CIO of Spider Rock Advisors, John Cole-Scott, CIO of Closed End Fund Advisors, Jay Hatfield, PM at Infrastructure Capital Advisors, and Simeon Hyman, Head of Investment Strategy at ProShares. I'm going to let each of them just quickly introduce themselves, talk about what they do at their respective firms, and we'll keep this brief, 30 seconds each. So Simeon, go ahead, and we'll go right down the line.
Thanks. My name's Simeon Hyman. I'm the Head of Investment Strategy at ProShares. Probably most of you in the room know us as the leverage and inverse ETF guys with funds like TBT. We have increasingly leveraged our, what I like to call, the low-cost provider of clever things core competency into a suite of buy and hold ETFs. And my team and I spend our time into product development work, understanding how our funds are performing, how they might perform in different environments, and of course partnering with you all to explain and help you implement those in client strategies and portfolios.
Great, thanks Mike. My name is Eric Metz, Chief Investment Officer of Spider Rock Advisors. Spider Rock Advisors is a registered investment advisor, and we specialize in customizing and automating derivatives-based and options-based strategies for financial advisors and institutions alike. Plain vanilla stuff is call overwriting, portfolio collaring, concentrated stock hedging, all the way down to the spectrum of a more convoluted hedge fund offering using volatility and derivatives as our core competency.
Hi, I'm Jay Hatfield. I'm CEO and founder of Infrastructure Capital Management, and we focused on investing in asset-based companies that have income opportunities with a particular focus on MLPs. And our firm is a co-founder of NGL Energy Partners, which is a New York Stock Exchange listed MLP, and also of the InfraCap MLP fund, ticker AMZA, which is the first actively managed MLP ETF.
I'm John Cole-Scott with Closed End Fund Advisors. We're a registered investment advisory firm that specializes in closed-end funds and BDCs. We have three main parts of our business. We do some structured product work in the UIT and some other data consulting. We do work with simply managed accounts for individuals, advisors, institutions, and then we actually resell our data resources to advisors, to hedge funds and whatnot. I've been doing that for about 15 years, and we are really just focused on helping investors and advisors understand both the guts of closed-end funds as well as that closed-end fund specific, like nuance of trading, discounts, and the impact of being a 40X structure.
All right, great. Thanks, guys. So what I've done, I've prepared about 10 individual questions. We're going to jump around. I'm going to just go from one panelist to the next. And in the last 10 or 15 minutes, we'll open it up to the floor for all of you to ask whatever you think is necessary. So let's start with Simeon. Let's just assume that we're going to be in some type of rising rate environment. If I want fixed income exposure, what should I be looking at?
Well, I think about the environment and I sort of think of the risk-reward trade-off. And back in August, the S&P pulled back 11% in just 6 trading days, and the 10-year bond rallied all of 12 basis points. So if you had, say, 10-year duration back then, you made all of 1% in the stuff that was supposed to bail you out. And I was at a conference just a couple of weeks ago where a fixed income PM with lots and lots of zeros on their AUM said, what we think in 2016 that the 10-year will probably go into the low to mid threes, so we're not worried about interest rate risk. And I said, well, I don't get it. 100 basis points with 10-year duration, you lose 10% of your client's safe money. So taking duration as a way to get higher yield certainly seems like sort of a bad trade these days. And one option is to just shorten that duration. But the problem if you shorten duration is you're getting almost nothing. And one of the reasons for that is those credit spreads start to get snugger and snugger as you go into short duration. So for us, one of the key opportunities is to take kind of a straightforward approach and here we thought, well, we're the guys with the hedging vehicles in ETF form. If you take that mantra and we package it up in a couple of ETFs, HYHG and IGHG, there's an opportunity to hedge interest rate risk explicitly, get rid of duration, but still have the maximum amount of what people call credit term premium, the maximum amount of credit spread that you can get per unit of investment grade or high yield rating. And that, I think, is a way to think about a prudent way to maximize yield in this environment, whereas just going for duration might be a risky thing. Going for a little bit of extra credit spread in a prudent way can be a very intelligent way to get a little bit extra yield, particularly because those spreads tend to get narrower if rates are rising from a relatively low level, because the economy is at least getting a little bit better.
You know what, Simeon, one of the questions I get when we talk about the interest rate hedge products is, what's your biggest risk? How do I get hurt in these products? What type of environment, do you not want to be in them?
Sure. And one thing to note is, of course, you don't lose money in an interest rate hedge vehicle if rates fall. You don't make any, so you may feel like you missed out on opportunity costs, but you don't lose money. Where you gain and lose money, aside from the yield, so the capital appreciation moving up and down, is from those spread movements. And in fact, up until about 6 or 8 weeks ago, we went through pretty much 2 years straight of widening spreads. You don't want to be in these products if you really think spreads are going to widen, because that's where you lose money. This is credit exposure. This is credit exposure without interest rate exposure. It's almost like kind of a credit arb indexed approach, if you will. So in an environment where spreads widen, that's where you will get hurt in these vehicles.
That's great. Let's move over to John, and an area that I love looking at because it's probably one of the last inefficient markets out there is the closed-end fund market, and it has its nuances and idiosyncratic risks. But John, when you are looking at the closed-end space today, and obviously most closed-end fund investors buy them for income and yield, right? You can find yields 6 to 10% all day long within the closed-end space, depending upon the type of vehicle you're looking at. Where is the most value right now in the closed-end space?
So we really want to focus on this panel. We focus a lot of our research on the taxable bond and the BDC space. We bucket them together because they're very similar structures. That's about $100 billion and about 200 funds. They have an average discount right now on a weighted basis, about 11% discount, and the average yield is 9.5. But what's interesting, when you think about that yield, that's a very high number. If you back out the average 29% leverage and that 11% discount, the manager only has to blend to 6.5 to fuel that yield. And so we really think that part of it is just understanding what the managers have to do at the guts level of the fund. The funds that we like right now, because we think rates will go up, we like senior loan floating rate funds, we like convertible bond funds. There's some of these funds at 12 to 20% discounts almost because they're currently unloved. And we also like the debt BDCs. Last time interest rates went up, senior loans, convertibles, and debt BDCs had very positive both income growth and total return for shareholders. And we think those sectors have been very, very positive.
Sure, and one of the things that, because I tend to get a lot of questions around closed-end funds in my day-to-day workings, and I think the biggest misconception, right, that there's no free lunch, right? When you get these types of yields, you are taking a ton of risk, right? I mean, what are closed-end funds doing to get these yields?
So they have the leverage. And when we talk to investors about closed-end funds, we say, we like the volatility of these market prices like option writers do. The volatility is the benefit to the closed-end fund structure because you're able to try to lock in better entry points and exit points. Now, the net asset value has volatility, typically more than ETF or open-end fund because generally there's more leverage there than the other structures. But on a muni bond fund, which is rather boring, the NAV standard deviation is like 4, but the market price standard deviation is like usually 8 to 12, depends on the environment. So you have twice the volatility of the market price, and some investors and advisors focus only on that risk. I would say the fixed capital, the fact there's no redemptions or push and pulls of money at bottoms and tops, managers can lock in their investments if they're good managers, is a benefit, but you've got to be willing to experience the volatility of the market prices. And so I say the risk is again, a risk is a benefit, but it's definitely understanding that you can't just simply do an open market order for a huge number of shares, unless you want to call me first and I'll be on the other side of the trade for you. You got to be a little more patient and diligent in closed-end funds. And we did put together some slides, even though we don't have them in this panel. They're out on the table. They have a lot of data we collect on BDCs and closed-end funds.
That's great. Let's switch gears a little bit, and Jay, let's talk about MLPs. I mean, I cover a number of MLP closed-end funds and MLP ETFs, and I can't tell you, I've probably gotten what it seems like is 2 million questions on MLPs the past, call it, 8 to 12 months. Like honestly, the first question I get is the MLP model itself broken, right? Is this structure flawed? Especially when looking at, say, the upstream or the midstream products. What are your thoughts around that question?
Well, I think first thing to focus on is when we talk about MLPs, we're really talking about the larger infrastructure MLPs, particularly the ones that are in the Alerian Infrastructure Index. So there's the 25 largest MLPs. And we think that model is very much not broken, that those companies have proven over the last 15 years to be full cycle companies. They're primarily investment grade, they're liquid, they have diversified operations, and many of their businesses are actually levered to consumption versus production. So the fact that US gasoline demand is rising by 4% a year is actually positive for them. We do think and have always thought that the upstream model was a bad one for MLPs. And so those are the E&P companies that are drilling and distributing cash. We always thought those were kind of a disguised, just liquidating trust, just like that have been out there, royalty trusts and other similar vehicles that have been out there 25 years back to when I was an investment banker at Morgan Stanley. So those yields really should be, whatever the reserve life is. If it's 4 years, 25%, 5 years, 20%, and that's the way they're trading now. I think that's one reason that we've seen kind of panic in the sector, because people have been blown up on Lynn Energy and some of the upstream companies, and that's tainted the sector. And it's going to take both the stability in energy prices and time for people to realize that they're really full cycle companies and probably a huge investment opportunity right now.
Right. What do you anticipate for dividend growth over the next year in the space for the midstream companies?
Again, thinking about the AMZI, so a pretty diversified portfolio with companies with a little bit more commodity risk and some with none. We think there'll be some attenuation in growth. So instead of growing 6 to 8%, probably grows 4 to 6, with some upside if the consolidation we expect to start does occur. So we expect the larger companies in the AMZI to buy the smaller companies, and that'll be accretive. And we also expect energy prices to stabilize next year based on our macro research. So we're pretty bullish, because if you get right now the sector is trading around 9 and you get 4 to 6% growth, even if you'd had no price appreciation, you would still have like almost 20% return. So normally, if you enter at this type of yield, you're rewarded pretty handsomely.
Sure. I mean, what do you think? I think we're seeing a fair amount of tax loss selling right now in the MLP space. I mean, what do you think? Where do you think a good entry point is? I think it's tough, because I think a lot of people that own MLPs feel that they have too much of them, right? They're not looking to add fresh capital, so we don't have like the marginal buyer to step up. I mean, what do you think the catalyst for that to change?
This sounds like a joke, but I would enter December 31st at about 3 p.m., literally, because MLPs just they always trade horribly, and I would imagine they'll trade worse unless we have a big energy oil price rally into the end of the year. But if you do buy them at the end of the year, either on the 31st or 30th, there's a tremendous January effect, because it's not just tax loss selling. People don't want to get the K1s, either when they buy a new one or they want to sell and get out of the K1, because that's expensive to file for a lot of taxpayers. So now I'm not certain that this is the absolute year to try to be that smart. If you want to build a position, you might want to build a little bit before then, a dollar cost average into it, and also not go all in on December 31st because of oil price volatility. But that is a seasonal that is out there. You just have to be a little careful, because oil is at 42, which could easily pop, and you might miss a little bit of a rally if you try to be too smart about it.
Sure, no, that's fair. And I think the next, and obviously you're going to be biased based on what you do, but should we go active or passive in MLP space?
Well, yeah, that would be self-serving, clearly, but we do think that it is a pretty dynamic sector, and there's sort of obvious trends, like we've been underweight in our active MLP, underweight commodity-sensitive companies, and now we've kind of neutralized that. And there's also corporate events like equity offerings and mergers that are pretty easy to optimize. And then in our fund, we also write covered calls, which we think particularly for MLPs is a very attractive strategy because MLPs, as a group, they're volatile, but individually they're not very volatile because they don't develop drugs or have technology changes. And then there's an ability to opportunistically run a little bit of leverage like now when their sector is undervalued. So we think it's, if you have enough levers, pretty easy to beat the index. So we are in favor of that.
Sure. And that's a great segue to my next question for.
Can I sneak
Yeah,
in
of
with a
course.
passive plug?
Sure.
Thank you.
Fire
If
away,
you
Sammy.
did want passive exposure, we do have an infrastructure ETF that caps the MLP portion so you don't get K1s, ticker TOLZ. So we could have the active passive debate all day long. It's a very valid one to have, but it's our job to offer the passive alternative. So.
And I would say, like, at some panels, some moderators say, well, if you have a certain size, then you should just buy all the MLPs. And I really, that's possible, that's optimal, but I think that getting 25 K1s is horrendous by any standard.
Sure.
Being somebody who does get 25 K1s. And so I do think that ETFs, whether they be passive or active, can be a superior strategy. And also then you can hold the ETF over long periods of time. That's where you get the tax advantages. Whereas there may be individual MLPs, you don't want to do that because of whatever dynamics are going on with their company.
Sure. No, that's fair. You had mentioned, Jay, you had mentioned call writing, and I want to ask the next question to Eric. Does it make sense, and the way I look at it, it's one of my favorite areas of the market right now, covered call strategies, right? In the current environment with kind of low to moderate equity returns and maybe an increase in volatility, the covered call strategy might be a way to go, right? Can you talk a little bit about
Yeah, so two things on that. Post '08, I think the options volatility arena really got put on the forefront of investing, maybe volatility even as an asset class by itself. And with the creation of a lot of the CBOE indices and the proliferation of VIX, both at the institutional and retail level, it's really put the space at the forefront of portfolio construction. And so you couple that with the yield and credit environment that we're in today, options as a source of yield really starts to step up, and advisors and institutions, investment policy committees at the foundation and pension levels are all eagerly looking and pursuing at the viability of these strategies as a core holding. So what kind of yield can you actually get? About a 1 year annualized S&P option is probably around a little bit north of 7% today. And if you look, John was mentioning the closed-end funds. I came from River North Capital Management, which is one of the largest closed-end fund shops out of Chicago. And we're salivating prior to me forming Spider Rock Advisors a couple months ago at the combination of large discount, both on a relative and absolute level, married with a covered call strategy. And so historically speaking, options are not new, covered calls not new. In the closed-end fund arena, they're very prevalent. In the open-ended space, there's been a mass inflow of product creation, both at the ETF level and at the mutual fund space. But the problem from financial advisors' lens and even their clients is the wrapper in which options usage is being honed in on, right? So do I want to sell my equities that are sitting on, in some cases, 30, 50, maybe even 100% gains if you're lucky enough to have ridden that whole ride, face the tax consequences, and buy a covered call open-ended mutual fund? And so what a lot of the feedback has been more recently is, I want the options, but I want them in my individual accounts. So how do you get them into your individual accounts seamlessly, systematically, and fiduciary responsible? It's very difficult, right? So what we do at Spider Rock Advisors is we are an implementation investment piece of each financial advisor's business in implementing options-based strategies, right? And so the reason why, a lot of the attention that we're getting is the wrapper in which we're delivering the solution, right? So we're not a fund. We deliver options-based solutions right into the accounts. So if you own Microsoft and Microsoft volatility, or AKA option premiums, becomes elevated, then our sensors and alerts will know that and give your clients yield via options on Microsoft. Vice versa, if you have a broad-based portfolio of ETFs and mutual funds, we can use index-based overriding. So regardless of your investment philosophy, whether you're 60-40, whether you use alternatives, options deemed as a source of yield is very prevalent. And the fiduciary responsible way to get them into your client's account so that you don't have to run around like a chicken with your head cut off on expiration Friday, rolling all your options positions for your clients. That's what our solutions help the financial advisor community.
Okay, great. Sameem, I'm going to come back to you, and let's talk about, obviously you talked about fixed income, to get access to yield. What about if you look at dividend-paying equities? Where should we be focusing on in this space?
Well, we focus on dividend growth, and I have to admit that a couple of years ago when we launched Noble, our ETF based on the S&P 500 Dividend Aristocrats, we really, frankly, tried to scare people into investing in it. And I guess it sort of worked because it's almost $1 billion, so maybe that technique worked, even though I feel kind of badly about it. And what we did is we reminded folks that if they were stretching for yield in their equity portfolios, they were bringing a lot of interest rate risk into that portfolio. And sometimes I ask the quiz question, anybody want to throw out what percentage of the S&P 500 they think is in utilities? And people will say 10, 15, 20. I've heard people say 25 or 30%. And I'm going to assume everybody in this room knows it's 2 or 3%. It's about 3 right now. So you're taking if you're seeking yield and you're loading up on stuff like that, you're bringing interest rate risk into the equity portfolio, probably not something you want to do. And that's a kind of a risky way to seek yield. Dividend growth as an alternative is a way to get not extremely high yields commensurate with the S&P 500, but to focus on quality. And the good news is that even if rates don't rise, those dividend growth stocks tend to outperform. We looked historically, dividend growth outperforms high-yielding stocks in the S&P 500 by about 200 basis points of total return when rates fall, still outperforming. So all those people we kind of scared into it kind of feel okay. But in the event rates rise, that outperformance doubles to around 400 basis points. So, in our view, a more prudent approach is of course, you try to tell your clients this, but indeed, total returns really important, and the growth of dividends is as important as anything else, particularly if we do have some more bouts of turbulence. These are strategies that across the board held up very well in August and September, and that's how you do get that kind of compounding of outperformance over time.
That's
great. If I can add to that real quick, Simeon brings up a great point in advocating for dividend growth as opposed to just the absolute yield value. And a very small piece of market information and anecdotal evidence more recently, probably in the last 3 or 4 years, is the valuation mismatch or valuation divergence between dividend-paying securities and non, even if they have the ability to pay dividends on a free cash flow basis, right? So you're talking the staples in the healthcare space, and maybe some consumer discretionary in some capacity relative to the cyclicals. And so there's a lot of research and work that's being done as to, is this a paradigm shift that's here to stay because of the yield environment that we're in, or is this valuation mismatch or divergence going to revert back to its historical mean? So it's very pivotal that you're honing in on, are you buying the security for dividend purposes only, or is the security standing on its own 2 feet from a dividend growth capacity standpoint and a free cash flow basis? So the biggest elephant in the room in yield investing in the equity space is, if that dividend were to get cut, and how it does behave in a crowded trade. I forget who on a panel earlier was saying that one of their core investing philosophies is looking for crowded trades, right? Spotting those and understanding why they might arise is paramount into that decision.
So we'll be in the room talking about a call writing strategy on Noble after the panel. Feel free to join us.
It's all coming together.
It's all.
John, I want to move over to you and talk about BDCs. I know that's something that you've been at the forefront the past year or so. And it's funny, about a year and a half ago, I was at a dinner with someone from one of the mutual fund companies, and they said, do yourself a favor for your career. Take a look at the BDCs. You should probably be picking up coverage of them sooner than later, because in 10 to 20 years, the market will be as big as the closed-end fund market. So I tend to, pay attention when someone like that says something to me, of that type of magnitude. So I guess the first thing, John, how do you do research on BDCs? Is it similar to analyzing closed-end funds, or
It-
what do we look for?
It is. I mean, BDCs are closed-ended management companies that elect to be treated by some special regulations Congress did in 1980 to actually help individual investors without accreditation, invest in small, private, or thin market cap companies. So they file N2 filings. That's how we see them when they're being born. But they do their quarterlies more like operating companies. But they have a net asset value, but only quarterly. They have, of course, they have leverage typically. The debt ones typically all have leverage. It's similar leverage. They do baby bonds, converts, than some of the leverage we see in the closed-end fund world. So our lens for picking investments is a trifecta of, is a discount more likely to go down or up based on the neighborhood and history? Is the dividend policy more likely to go up or down? We're trying to avoid the downs and experience the ups. And is net asset value performance, which means the manager's results after cost, is it appropriate? Is it better than average? And when you balance those out, it helps you do the work. So whether it's understanding whether it's first lien loans, which are very common in the BDC space, which means they're more security, about 55, 60% of the loans in the market are that type. About 75% of the loans are variable. Now, we've also seen BDCs really grow, as you mentioned. In 2004, the last time rates went up, there were 5 debt BDCs. There's currently now 42. And the last one launched was Goldman Sachs, who has 2 MLP closed-end funds and now a BDC, and they hadn't done a closed-end fund since pre the 1929 crash. So I'd say it's similar, but it's different because they're less homogenous. Like there's 190 some muni bond funds that act similar yet different. The 43 debt BDCs act very different. The manager's personality and skill in getting good deals and protecting shareholders and treating shareholders well, far more impactful to an investor of BDCs. Yes, you can trade around the yield, trade around inefficiencies. If there's a secondary and the stock pops down, it's often a good time to buy a good manager. So it's similar, but there's nuance, just like there's nuances how you look at an MLP closed-end fund versus a muni bond closed-end fund. We just think it was another sector that's growing and that's helping to fuel the U.S. economy.
Sure, no, that's fair. And
I was going to say, there's another way to look at BDCs, and we view it actually as a form of listed private equity, and they're also equity BDCs. So as another way to think of your investment, and yes, another passive ETF from us, that you can look at the BDCs as a way to act, that one of the closest ways you can get to a listed form of private equity on both the debt and the equity side. In fact, you can make a pie of the BDCs and slice it into all the pieces of private equity, and it's not a bad way for smaller clients to have some of that diversification benefit.
And I'll say we do have a nice UIT, which is actively selected by me and passively held. That's available for people that can work with Smart Trust. But yeah, there's lots of ways to do it individually through funds. There's a closed-end fund that does it. There's a couple of there's 2 small open-end funds that do it, but I think, yeah, there's lots of ways to get exposure to the sector.
And it's fair to say they're more credit sensitive than interest rate
Yeah,
sensitive?
so people say, this is not a duration risk. And in fact, the correlation of BDC performance to like munis, which are very duration risk closed-end funds, is like negative 10. So I mean, really, if you're trying to hedge out the correlation of duration risk versus this stuff, yeah, this is all managers write good loans. They get bigger yields when they take more risk. Typically recovering a first lien loan is 75 cents on the dollar. A second lien loan is about 40 to 50 cents on the dollar. Unsecured is like 20 cents on the dollar. So they'll write bigger loans where they're getting paid enough that they worry about the recouping of the assets. Should they need to, they'll make it. And yeah, these definitely are, when rates go up, you should see these yields kicking up in step with rates, bumpy, but along the way.
Which is more efficient, the closed-end market or the BDC market?
Oh gosh, that's an hour panel in itself. So I would say that there's more trade volume on average in BDCs, and they tend to react much more on their quarterly earnings or a press release. Like, it's hard for a regular closed-end fund to jump 1 to 3%, take some serious effort outside of market movements. BDCs can do 3 to 10% a lot easier. So I would say that there's more liquidity in BDCs, but there's way less efficiency, which is one reason we love it. We love inefficient sectors. That's why I have a job, I guess.
Sure, no, that's fair. And then let's just wrap it up. I have one more question for Eric, and then we'll open up to the audience. Just in general, I mean, what are you seeing? And I always look at client sentiment as being an extremely important indicator. What are you seeing with your clients right now? Are they afraid? I'm assuming a lot of them want hedge strategies, so that's why they come to you.
Yep.
What are you seeing right now with most of your clients?
Yeah, so I'd say predominantly, I haven't checked my iPhone in the last 45 minutes. So I don't know where the S&P is on the year, but it's hovering around flat or unchanged. And the 60-40 model is, maybe flawed in breaking down at its core, right? Why? Because the fixed income climate as you want to de-risk your equity beta, historically you move it over into the fixed income arena. Now with the proliferation of alternative assets, there's a new model, there's a new paradigm or regime, or whatever that composition is, that's on a client-by-client basis. But the drastic desire to reduce equity beta, which some people perceive that as just blindly reducing volatility. Those are two different distinct topics, right? Reducing equity beta and reducing equity volatility, those are two different topics. And so what they want is they want to reduce volatility. They don't want to actually reduce equity beta. I think Jason from Strategas a few minutes ago was mentioning the TINA alternative. There is no alternative. That's how all of our clients are viewing this. There is no alternative. I'm forced to be in equities whether I like it or not, right? So how do I manage that ride? So volatility reduction is actually what they're seeking. That's what the fixed income component has typically done in the 60-40 model, right? Simeon a few minutes ago was mentioning the S&P down 11% in 6 trading days and the 10-year only recouping 1% of those losses, right? That dynamic is not going to change, right? The math behind the fixed income equation is very different today from a risk management standpoint than it was for the last 30 years. And so reducing equity beta is what a lot of our clients are telling us they want to have done, but in practice, what they're actually asking for is reduction of volatility. And so, our solutions are to kind of pose them with those questions, present those issues to them, and then steer them and hold their hand in the right direction. So they're trying to, become more aggressive in converting their core equities, call it 60, maybe taking a 10% piece of that, of their whole entire pie and implementing an override program on that, whether it be single names, ETFs, or mutual funds. So the reduction of volatility is, at the end of the day, what most of the clients are seeking. They just approach it from, I need to reduce equity beta.
Sure, no, that's great. All right, we have about 10 minutes left. Let's open up to the audience for questions, if there are any. Quiet room.
We're that good?
Yeah. Sure, hold on one sec for the mic.
This is not a question, just a comment. The argument between the closed-end funds and the BDC. And my friend here made an excellent presentation. However, there's several points that were so important. First of all, BDC either pays quarterly, monthly, and so there is a income being flow. Not necessarily all the closed-end funds are the same, and it's listed. They're all 40 Act companies. And then especially during the time when small and mid-sized company requires financing, they cannot go to the bank to get financing as much as they can. They can go to BDC, and they get very advantageous, low rate. So it's just one of the things. It's almost like daily liquid, and you mentioned about hedge fund and private equity fund. The same thing as daily liquid alternatives. But BDC is really listed company, so I think I would vote for BDC is more preferable.
I think one other thing that should be also highlighted is BDCs have a tendency, just to operationalize your comment about being inefficient.
Yep.
Yeah.
Their discounts can blow out to almost an unlimited level. I think most of the ones that we follow have touched at up to 30% discounts to book value. So it is a way more inefficient market, something where you have to do more research, where even though I think that almost all retail-oriented yield investments are very, very cheap right now, most closed-end funds kind of max out right around 10.
10,
That's
12.
where you see people like kind of bottom fishing.
Yeah.
Whereas BDCs can get way more dislocated than that. And
You get higher
that's
yield,
good.
though.
It's both good and bad news.
I mean, your former cohorts at River North are currently taking on Fifth Street, trying to get some board seats and make their relations with shareholders a little friendlier. Activism in BDCs, I think, will be very big next year. But like you said, I mean, the neighborhood is, 75% of the loans BDCs write, there's like 4,700 loans that we follow in our database, are under $25 million in size. So these are really 5, 10, 15, 25 million. Yes, their BDCs are write a $100 million check, But the most of these investments are to small U.S. businesses
Yeah.
that aren't being served by banks because they can't make the risk-adjusted return anymore on them. But that's why BDCs are growing, is because banks don't do this lending.
Exactly.
Good
And it
point.
helps the economy as well.
But activists do protect you, and they're working on BDCs
I love
currently.
BDCs.
So.
Just from an operational standpoint, if you're a BDC novice out there, when you see a fund that owns BDCs and you see these really large acquired fund fees, don't freak out. That's just something that's a normal P&L item in a non-40 Act fund, but in a non-40 Act being held in a fund, but you have sort of a fund-to-fund mandate of accounting, so don't worry about it. A bunch of people have white papers. You probably have one that'll explain it.
BDCs
So don't
average
freak out.
10% a year last 10 years, but they're acquired, like their average expense ratio, if you think of it like a regular closed-end fund, is 10%. Because these are boots on the ground, writing private loans, servicing these clients. These are not, it's not like trading a muni bond portfolio, which takes great skill, but it's a lot more effort. So yeah, the acquired funds fees, when the advisors see the 10% fee, they come and go, they ask me, well, I'm sorry, it's a private equity vehicle that you can buy every day. You know, it's not cheap.
Sure, no, that's fair. Any other couple of questions over here?
Question here.
Sure.
I guess for Jay. Seems as if closed-end funds for MLPs have just been reacting to a situation of kind of panic in the MLP space. And you referred to, or I think you did, to wanting to see oil prices stabilize to turn around the market performance situation for MLPs. And I'm just wondering how an investor can choose a closed-end fund that's less susceptible to oil prices. And wanted to ask if there's an issue of how investors are choosing closed-end funds and even MLPs themselves. Are the investors confused about whether they should be looking for the place with the highest yield or looking for the place that provides the business positioning that they want?
Well, I guess just to address the oil price issue, MLPs are 70% correlated with the XLE, so that's the S&P Energy Index, and 40% correlated with USO or oil prices. And that probably dramatically overstates their cash flow sensitivity, but because of the volatility, that's just the way they are right now. So you can argue till you're blue in the face that they shouldn't go down, at 70% of what the XLE does, but I think that we're just stuck with that for now. That's what's going to happen, and partly, again, because of the upstream MLPs melting down. And then, I guess, in terms of differentiating among the products and even the companies right now, the kind of 90% of your bet is going to be on the sector because it's so dislocated right now. It's trading at a 9% yield, and in theory, it could be as low as a 5% yield. I don't think it's going to go there, but you really have a valuation that could literally be 50, 60% undervalued. So you can select the ideal closed-end fund or our ETF or anybody's ETF, and I would assert that you're making kind of 95% bet on the asset class and 5 on the differential performance, other than looking at leverage. I mean, everybody has their beta to the sector, but assume you adjust for that. That would be the one proviso, is you can calculate the beta for closed-end funds are higher typically than they are for other funds. But if you just did beta adjust them all, then you're going to essentially be making the same bet.
Yeah, and just to add, because there were a number of questions that you asked there, one of the things to focus on with the MLP closed-end funds is they all use leverage, right? And most of them have done some form of deleveraging, some more than others. And not every fund is deleveraged, but a lot of them or most of them have. So that is something that's, you have to be cognizant of on the closed-end side. And when we're looking at them, we're trying to pick those that have had to deleverage less or have not deleveraged at all. So that is something to pay attention to right now. Check.
Yeah, this question is either for John or any of the panelists. Earlier this year, senior loan funds, either in a closed or open-end space, are quite popular, and they did pretty well. But I would say within the last 6 or 9 months, they've we've seen negative flows on the ETF side, and the performance really hasn't been there. Could you maybe elaborate what your views are and why that is, especially with rates looking to rise, and do you think that might turn around anytime soon?
Yeah, I'd say the same could be said about BDCs, which are also highly floating loan based. I would say our perspective is, discounts ended third quarter 2015 at the widest point in the last 20 years, except for the financial crisis. They briefly, slightly deeper at the Asian financial crisis in 1998, but after 9/11 and every other horrible thing that's happened in the last 7 years, the discounts didn't blow out as much. I think it's just people that associate yield and rising rates with negative performance, even though their gut tells them that a floating rate loan will go up when rates go up. They still have this sentiment of what will happen into the sector. So I would say it's just people, it's a great opportunity if rates do go up to be in that sector. And I know the closed-end fund managers there love to take the redemption pressures from the open-end fund managers.
And I would just echo that. I think that we're just in a profound retail overreaction to a 25 basis point increase in short-term rates. Our macro research would indicate it's much more likely to have a flattening yield curve than a blowout in the 10-year. And even if we did, that's most of the products are even overcapitalizing a 3% 10-year. So it's just been, investors seem like they're just on off. It's like, oh, rates higher, blow out everything that has yield and come back in a couple of years.
Though there is a real element to this senior loan challenge, which is the floors and those interest rates, which are often in the sort of LIBOR 100 to 150 bips range. So they aren't going to float anywhere for a while, which means they do sort of have some actual duration risk at these low levels of interest rates. It's one of the reasons why combining some bank loans with an interest rate hedge pile of high yield bonds is not a bad way to go, because you get some sort of straight bond credit exposure along with the bank loan piece, because they don't always do the same thing at the same time.
That's a good point, and my 2 cents on it. In the past, I think what you've seen, you typically see money flow into these products prior to the Fed acting. I think this time, though, and I want to say it's a lot different, but I think money will flow pretty aggressively. Let's just say the Fed does hike in December. I do think money will flow pretty aggressively back into these products. So I think that we're a little bit at a show me, story right now. And I do think, to Simeon's point about the floors, I actually think investors will look past the floors, especially on the retail side. I don't think most retail investors understand the floors. So I do think you could see money flow aggressively back into this space.
Plus, a lot of the loans we've seen written recently, BDC or senior loan, hadn't had the floors. So the longer it gets, there's less impact. There's a lot more than that going on. But.
Any other questions? All right, well, great. Thank you so much.